So good morning, everyone. I'm just going to give you a very quick update on just a couple of VAT things that are relevant. So one of the points I want to talk about is quite new, it's quite recent. And another one is not as recent, but it seems to have gone under the radar a little bit. But it's quite important to talk about. I'm then going to hand over to Jamie, who's in our customs team, to talk more about CBAMS and a couple of the customs things that are actually taking up a lot of his time at the moment. So for those who haven't heard me talk before, I'm a VAT director here at Crowe. And yeah, let's carry on. Okay, so the first thing we want to talk about is something that is new. Last month, the government announced a package of tax reform proposals, and these included the proposed changes to what we call the Capital Goods Scheme, or the CGS. So for those of you who don't know what the CGS is, the CGS applies, the Capital Goods Scheme applies where goods and services are used for activities that are both taxable and exempt from VAT. And this is where VAT is partly recoverable. So for most expenditure, the VAT recovery is calculated in the period in which the cost is incurred. Under the Capital Goods Scheme, or if you are partly exempt, there is then the initial VAT recovery is recalculated after the VAT year end is up. It's what we call an annual adjustment. There are also similar rules that apply for any not-for-profit, so anything that has non-business use of the item. Now, for certain capital expenditure, the VAT recovery, that initial VAT recovery, does need to be considered over a number of years, usually 10 years, but it could be 5 depending on the asset. And then if that use of the asset changes in subsequent periods, there's then an adjustment to basically adjust the initial VAT recovery. It's quite a complicated calculation. And the items which generally fall within the Capital Goods Scheme are a computer or single item of computer equipment, aircrafts and things like that, ships and boats. Very rarely, I think in my 25 years of working in VAT, I've seen one aircraft, never seen a ship calculation. But the common one, which is the one I want to talk about today, is property expenditure. So it includes acquiring land or buildings, constructing a building, or a major refurbishment. So, and for buildings, the Capital Goods Scheme applies when you spend more than £250,000 plus VAT on any capital costs, and that's on VAT-bearing expenditure. So for a lot of businesses, sometimes you don't always know that this applies, because if you are a business that just buys and sells, or you're fully taxable, so if you charge VAT on everything that you do, the Capital Goods Scheme is very rarely ever crosses your mind, and that's where actually it can be a bit of a sticking point. So just by way of an example, a manufacturer business could incur £1 million plus £200,000 plus VAT on building a new warehouse. It's able to recover 100% of that because everything that business does is VATable. 8 years later, they need more space, so they sell the property without what we call an option to tax. That's an exempt sale. There's a change in use. It's still within that 10-year period, and that business inadvertently ends up needing to repay £40,000 of VAT to HMRC. So usually it's the businesses that are fully taxable that have these major capital expenditures where it can quite easily fall within the rules. So what are the issues and what's changing? So capital goods schemes can be quite complex and time consuming. And as I've just said, it can be missed entirely. The thresholds, so this £250,000 plus VAT, they've not changed since this was introduced in 1990. So it's very outdated. And that's resulted in a lot more people being caught by these rules. That probably wasn't the intention when they were introduced. So meanwhile, as I mentioned, computers prices of computers have decreased. It's very rare to see IT equipment costing, and it's £50,000 for IT equipment costing that much, whereas property and construction costs have actually just increased over time. So the government's proposed changes, they're basically going to they're looking to remove computers and computer equipment from the CGS, but also they propose to increase the threshold for CGS on property up to £600,000. So that would mean that a lot of like refurbishments, for example, may well fall out of it. So there's not yet an effective date for these changes. And we do anticipate that these changes will apply to new fixed assets created after that date. So if a business is currently calculating capital goods scheme for an asset that it has on hand, they'll continue to carry on as normal. So just a quick one really on that update that was last month. So it is still proposed changes. Nothing has yet been announced as to how it will look in final, but we do know that they are looking to increase that threshold, which is quite welcome. The other thing that I wanted to talk about today is managing your VAT obligations. So HMRC began publishing guidelines for compliance back in November 2021 with the intention of highlighting complex or commonly misunderstood or novel risk areas that occur across alternative tax regimes. These taxpayers do not have to follow the guidelines, but as HMRC says in its guidance, doing so may mean avoiding unnecessary contact from HMRC and reducing the risk of paying any additional tax or interest or penalties. And I think at the time of, so at the moment, there's about 12 guidelines covering a wide range of areas. So I'm just going to quickly mention the VAT. So in September 2024, HMRC published guidelines for Compliance 8, which relates to VAT compliance records. The guidance sets out HMRC's recommended approach to governance, controls and processes with regards to VAT accounting, focusing on risk management and how taxpayers can reduce the risk of making an error. It applies to all VAT registered businesses and there is no minimum threshold. However, the rules should be applied appropriately considering the size and the complex of the organisation or the business. Therefore, it's the controls and processes needed for a large corporate that's maybe under senior accounting officer are going to be very different to those for a small business. The guidance provides detailed expectations for the types of controls that should be in place, how these controls should be documented, and also the circumstances under which controls should be reviewed and reevaluated, and the ownership of risk management. And in total, there are 10 sections in areas such as the systems in place for the business journey from basically ordering through to payment, for capturing, authorising and paying employee expenses, for example. The accounting processes for collecting, processing and presenting information. Control objectives for VAT reporting and manual adjustments. And a few other things. And what I wanted to do today is I'm not going to go into a lot of detail just because of the timing, but I just wanted to cover a few of these key points because I think these updates have very much gone under the radar a little bit. So covering expectations. So HMRC's expectations with regards to a business's management of its VAT position, they are clearly set out in this guidance. And the guidance emphasises the implementation and use of good practices, highlighting the importance of risk management, control design, and also documentation. The one thing I always say is whatever you decide, just make sure you've documented your decisions, because if you make a decision now, in 4 years' time, when HMRC come knocking, it's easier to explain to them why you've done something that way. So for record keeping and audit trails, HMRC's expectation is for there to be a clear audit trail of documentation, providing an accurate position to support a VAT treatment. And that's reiterated in a number of the sections within the guidance. The guidance also sets out the need to ensure that the VAT treatment is correct, ideally before sales or purchase orders are issued. That documentations are added at appropriate moments, such as export documentation to support zero rating. And invoices and credit notes are clearly created accurately and issued in a timely manner as well. And throughout the guidance, HMRC recommends particular controls at each stage of the audit trail to help manage that VAT risk. Another area that I just wanted to point out as in this overview is VAT reporting checks. So every business will have its own way of managing compliance, but the guidance lists out some robust practices applicable to all. And these include the fact that spreadsheets are still accepted. However, HMRC expects that businesses use version controls to manage them, automatic links rather than manual intervention, drop-down menus instead of free entry, train developers if need be to ensure that files work as expected. Risk-based checks are expected to be carried out, and HMRC highlights the use of a trend analysis is good practice. So comparing, say, a VAT return for one quarter in the year to the same quarter last year, and having a look at what the differences are. Also, automation and IT systems use. So HMRC has set out previously its ambition to become a digital-first organisation. This guidance reflects that message. Several sections of the guidance focus on a business's IT infrastructure and highlight how it should be used. So just quickly to cover off using the guidance, while the guidance is very detailed, it does provide taxpayers with some clear insights into HMRC's expectations regarding controls, processes, and also documentation. So ultimately, it should be quite helpful to taxpayers. So for many businesses, complying with these requirements will necessitate involving other people beyond the tax and the finance teams. For example, checking that appropriate controls are in place, such as with master data or import and export documentation. And it's important for businesses to act on this guidance. So if errors are made and the guidance has not been applied, it may be harder to argue that reasonable care has been taken. So that can have a knock-on implication with regards to penalties. And we are aware that HMRC has been discussing this guidance with other businesses as part of VAT inspections. So we've seen this crop up. So I think just to summarise that, while these new guidance is helpful and it is quite detailed and it gives a clarity on HMRC's expectations, it also does require many taxpayers to take action to meet these standards in certain areas. So I wanted to quickly just discuss this because it does seem to have gone under the radar. HMRC haven't really shouted about this. But if you have any questions, I'm assuming we'll do questions at the end, Suzanne, if there's time. But I do have, I'll share with these slides with Suzanne afterwards. My contact details are on the slides anyway. So now I will hand over to Jamie to discuss customs duties.
Thank you very much, Hayley. I'll just share my screen and crack on. Give me a moment. Okay. Right. Okay. So, good morning, everyone. I'm just going to very briefly talk about the current international trade environment and CBAM. Which does roll off the tongue nicely, the carbon border adjustment mechanism. But clearly at the moment, all anyone has been talking about over the last 3 or 4 months seems to be tariffs, customs duty, which is very much my wheelhouse and my day to day. As customs professionals, we sort of thought we had our 15 minutes of fame back during the Brexit era, and now it seems we're being put front and centre again, mainly due to this man and what's happened over the last 3 or 4 months. So he's I don't like to focus on him too much, but it's hard not to at the moment in the international trade environment because he is creating a new normal. Really, he is quite obsessed with tariffs. That's probably the only quote that he said that I could have also said about tariffs. But he has taken it to a new level. So what's happened over the last 3 or 4 months now since January the 20th is really he's reset the global trade agenda, and he is coming up with new rules, and it's been a very interesting 3 or 4 months, very much driven by this shift towards protectionism. So clearly, Mr. Trump wants things made in the US. He wants to reshore US manufacturing, and in doing that, we've had I think at the last count, over 55 new or revised tariff measures since January 20th. So it's been an incredibly volatile. It remains incredibly volatile. For businesses, it's the uncertainty that's almost as harmful, if not more harmful, than the actual tariffs themselves. And these kind of measures have all sorts of unintended consequences. So we've seen a raft of tariff measures, but also non-tariff measures, which just increase trade tensions globally. I think maybe what Mr. Trump underestimated is he absolutely applied tariffs himself, but there's been a huge retaliation and very strong retaliation from the EU, UK, or threats of retaliation, which create this very uncertain, volatile international trade environment. Advice we give today, unfortunately, sometimes does go out of date even by the end of the day. Things are settling down slightly now, but what this leads to is just growing complexity in international trade and customs requirements. So that's where we come in my day to day is we help businesses make sure that they are fully compliant, paying the right amount of customs duty or tariffs, not too much, not too little, and that's just become a lot harder certainly into the US. But the knock-on effect has been globally that everything around customs declarations and moving goods from A to B internationally has become more complicated. And when tariffs are involved, there's a compliance risk of not paying what you owe. So what we're talking to clients about is making sure they understand their obligations, making sure they're very clear on what do they need to pay from a customs duty or tariffs perspective, and that applies as much in the UK or EU or as in the US. It's just very much highlighted what needs to be done over the last couple of months due to the global focus on every time I turn on the news, the ticker says tariff somewhere in the title. One of the things we have done over the last few months, and we committed to this, and it's proven quite difficult, probably more difficult than we were expecting, is we have on our Crowe Customs Hub a Trump tariffs timeline, where we update almost on a daily basis with the developments. That's become a bit easier over the last couple of weeks, but we've been monitoring all developments because our clients need support with it. They need to understand what's the latest position, and what do I need to do. Our general advice has been let the dust settle, but keep abreast of what's been happening and understand how it affects businesses if they're importing or exporting to or from the US. But as I mentioned, the knock-on effects are beyond just the US as well. Just to also touch on a couple of other recent developments. This is everything I'm talking about, really, apart from CBAM in a minute, has happened in the last month. So May has been a monumental month, really, for international trade. So we've had all of the US developments. We've had, as part of the Trump tariffs and Trump tariff reaction, we've had a UK deal with the US to try and get us closer to where we were in January. So it doesn't really improve anything from where we were before pre-Trump, but the UK deal with the US hopefully, once it's formalised, does get us closer to the position we were in January. And then we'll have to see what deal other countries get. He's agreed a deal with China, I think, as I referenced in the last slide, but he has, in the process, created a new normal. So whilst the tariffs on Chinese goods, and it applies if you're exporting those goods from the UK, are not 145% anymore, they could still be 40, 50, 60, 70%. So still really, really significant. But just one update that's definitely worth talking about from last Monday was the UK and EU have had, we talked about Trump trade reset. The EU and UK met in London last Monday to agree a UK EU reset as well on our relationship. And a significant part of that was about trade. One of and these are positive developments. We have to wait for the substance. We don't know the detail. We don't know how long it's going to take. But the two sort of headline bits of news from that are an agreement on food or SPS or sanitary and phytosanitary products. So the best way of explaining that is since Brexit, gradually, the UK has introduced controls on food products being imported from the EU. The EU has done the same from day one. It means if I want to import cheese or meats from Italy or Spain, I need a health certificate where an actual vet needs to go onto the trailer and have a look at the goods and sign a health certificate. What we seem to have agreed is to remove those regulations and red tape around moving food products. So that will be a really positive development if it materializes. The second development, which links into what I'm briefly going to cover in a minute, is the linking of our emissions trading schemes. So both the UK and EU have emissions trading schemes where effectively a price is payable for the carbon emissions businesses emit. We've said that we're going to link those schemes so that the price in the UK is the same as the EU, and that has all sorts of benefits for businesses going forward, and we'll touch on that. The other Again, this has happened just in the last month. This is how much is going on in international trade at the moment. The UK and India, after a long time of negotiating, have agreed a trade deal. Most of our trade deals since Brexit have very much been, well, rollover deals from the EU. So deals we already had in place. This is a genuine, bona fide new trade agreement that we've managed to negotiate. It will, over quite an extended period. So from what we know so far, over a 10-year period, phase out tariffs so that in 10 years' time, if I'm importing goods into the UK from India or exporting goods from the UK to India, there won't be any customs duty at all. But that will happen over a phased period of 10 years. So we need to wait for the detail, but another positive development in UK and international trade. Okay, just to very briefly touch on CBAM. So CBAM has become a real area of focus for me over the last 2 or 3 years and our team. It is the carbon border adjustment mechanism. We sort of by accident have fallen into having this as an area of focus because our clients, particularly our manufacturing clients in the Midlands area, needed support with it. What it is, for those that don't know, is completely revolutionary. It's the first of its kind in the world. It's part of the EU's goal to be carbon neutral by 2050. And the idea is to apply a price on the carbon emissions embedded in certain goods imported into the EU. So the EU, as I've just mentioned before, and the UK, we apply a carbon price to certain goods produced in the UK and EU, but we don't apply that same price to goods being imported. So the idea is to level the playing field between producers and importers. And that's what CBAM will do. From January 2026, in 6 months' time, the EU will charge a price. There will be a levy on the import of certain carbon-intensive goods. It will generate revenues from the EU, but that's the bit they don't talk about. Why the motivation behind it is about climate change and to try and combat climate change, but also level the playing field, as I mentioned. So it only applies for now to goods that I've brought up on the screen. The biggest impact by far is on iron and steel, and that includes things like, even at the moment, things like nuts and bolts, screws, key rings. So there are some finished products that are already in scope. Over time, this is going to expand. So there's going to be a lot more products over time that come into this scope of CBAM. But for now, this is where we're starting. And I mentioned that the timeline, we've been in the EU in this reporting phase, and then in January there will be the definitive phase. And if an EU importer imports any of those goods over a certain threshold, they will have to pay a price for the carbon emissions embedded in those goods. UK CBAM is coming as well, so we've got a bit more time for that. UK CBAM is a year behind EU CBAM, so EU 2026 when a price is payable, UK is 2027, but the same sectors are in scope. If you're importing any of those goods into the UK, there's a £50,000 a year threshold, but if you're £1 above that threshold, then you're going to need to pay a price and report the carbon emissions embedded in those goods that you import. So we're a bit behind. The linking aspect that I discussed that the EU and UK have agreed, that just helps the movement of goods between the UK and the EU. So if I'm importing directly into the UK or directly into the EU, I need to manage my CBAM obligations. But the idea behind the linking is if I'm moving then goods subsequently between the UK and EU, in theory, I won't need to pay a carbon price, but I will, because it's already been paid, but I will still need to likely have to report that movement as well. So it's in its infancy, as I mentioned, very much revolutionary. Everyone's learning, but in time, as they gradually expand the scope of both EU and UK CBAM to more finished goods, things like washing machines and household goods will absolutely be covered by CBAM in time. It's going to become more and more relevant. Okay, so yeah, that's a brief, very brief international trade update. The developments, even in the last month, were the kind of developments that we'd probably see one of those announcements a year. It's a very volatile, uncertain international trade environment, but we're trying as best we can to keep on top of all of it. So hopefully that gives you a very brief update on where we are.
So Nick Roundtree from System 15. Nick, are you all right just to share a little bit about what you're seeing sort of cyber side at System 15 and Cyber Essentials?
Yeah, absolutely. Thanks, Suzanne. So it's timely, much like the talk about tariffs and Trump. We're seeing a lot of stuff in the news recently about cyber and cyber security. Mm-hmm. Obviously, Marks and Spencer's, Co-op. I read last night that Adidas, the latest high-profile victim, they've been hacked as well. So it's happening a lot. And what it actually does help is raise the awareness of what's going on out there. So I've got a few slides, if that's okay, just to talk you through how we can help protect ourselves as business owners. So I'll just share my screen over here. Okay, can you see that at your end?
Yes, we can. Yes.
Great. Okay. So basically, Cyber Essentials is it's a framework designed by the government over 10 years ago now in response to industry leaders saying, okay, I'm really sort of confused about how I can best protect my company. You know, cyber is a very complex area. Can we have some guidance on what best practice, what measures we should be putting in place to help lock down our internal systems? So the government helpfully came up with this framework of ideas about how you should be looking to protect your company. So effectively what it does, it splits it down into 5 areas that we'll cover off shortly, but it's designed to sort of demystify and reduce some of the complexities of what you need to do. So who's it for in terms of protection? Well, every company can benefit from having Cyber Essentials in place. There's a significant framework to really help protect you against the most common cyber threats. Now, it's important to note that even if you have Cyber Essentials certification, you're not going to be 100% invincible. There's not a magic bullet. The idea is to give you a very good baseline protection across your entire company. What's really useful as well, some of the stats on the right-hand side of the page there, talking about once you have achieved that certification, you put these measures in place, 92% fewer insurance claims are made because of this. So it's a really sensible thing to get in place. So what is the importance of certification? So in addition to sort of like significantly improving your percentage of your defense against threats, there's some other interesting areas we can look at as well. Trust, one of the biggest things. What we're seeing up and down supply chains now is, have you got cyber essentials? You're being asked of before you can even think about entering into some tenders. We've got clients, say, in healthcare verticals or in aerospace, and they want to sort of open up the door to some tenders. If you want to deal with the government, particularly the MOD, they won't even talk to you unless you've got cyber essential certification in place first. So what it does, it shows that you're taking a proactive approach to maintaining the security of your clients' data and your own data as well. But there's also certain sectors where it's a mandatory requirement to have cyber essentials in place. So, for example, if you work in the legal sector, the Law Society demands that you need to have cyber essentials in place. So it's something we're seeing more and more requests coming in of how they can achieve certification and what are the steps in doing so. So the way that the framework tends to operate is it tries to split the vast array of things you could look at into 5 key areas. I won't dwell too much on these because I'm conscious of time and the technical detail behind this. But those are the 5 controls, they call them, where you need to focus areas to improve your cyber posture. So within these 5 areas, there's probably about 40 subsections of improvements you need to make within your company. And the framework's really good because it will guide you through where you need to pay attention. So it's not just a case of saying, yes, I've got antivirus, I've got a password policy. There's a lot more to it than that. So that the framework says, once you've got all these measures in place, you're in a pretty good shape. Now, one of the questions that we get quite a lot is, how do I know what my current stance is? So helpfully, they've put together almost like a gap analysis, an online form that you can fill out. And it's very simple questions. And they say, how many staff have you got? What type of devices? And you fill out these basic answers. And at the end of it, it's a free report they'll give you that you can download. And you can use this effectively as a gap analysis. How far away from achieving Cyber Essentials compliance are you? So I'd recommend, if you're not already Cyber Essentials certified, download that tool. And I can share the link afterwards with you or drop it in the chat and have a look how far your company is away from achieving that certification. What it will do also, the report will guide you through where improvements need to be made. So if you say, I don't have an employee onboarding or offboarding policy with regard to IT, it can give you some bullet point ideas of what you need to cover off in order to achieve Cyber Essentials certification. So once you've got that report, that gap analysis, what do you do with it? Well, the next stage obviously is to create an action plan. So taking the basis of that report, you then start working with departments internally to say, what do we need to do to get this in place? So Cyber Essentials isn't just IT focused. There is HR requirements in here. There's board level sign-offs you need to do. There's process and policy that need to be in place. Some of it will need to be backed up with some IT data. So you will need to work with your IT team on some parts of it. But other parts are just things like acceptable use policies. So more of the HR side of things. So once you've worked through getting all this information together, the next stage is the certification process. Now, the way that works is you can download a set of the questions that you'll need to go through in the certification process free of charge. Again, there's a link on the slide there. I can drop that in the chat afterwards. And you can have a look at what the questions are like before you submit your answers. So it's a really good way to help prepare for the actual submission process. Once you've submitted your answers, they will be marked by a qualified assessor, and they'll come back with a pass or a fail, effectively. Now, the guys are really good. If you've failed in any area, they will give you some advice on how you can improve. And you get the opportunity then to resubmit your answers once you've made those improvements. So in terms of the actual certification process, you'll pay a fee to the assessors depending on the size of your company. You can see the gradings on the right-hand side there. So the fee basically is for the assessor's time to go through and mark your answers and give you that feedback. Now, what you need to do is make sure that you answer these questions appropriately. So working with your IT provider, they should be able to advise on the most appropriate wording. So, for example, the assessors might say, have you got a password policy in place? If you just put yes, that's not good enough. They want to know a bit of detail behind that as to what that actually looks like. So it's knowing the answers to submit that are going to help you get through the certification process. Once you have achieved certification, though, that's great. What you get is a badge to go on your website and your marketing materials. You'll be registered online as a company that successfully achieved cyber certification. When companies want to look you up to see, have you actually got that certification piece, your name will appear online. So it's a really good thing to have. And additionally, if your company has a turnover of less than £20 million, successfully achieving certification entitles you to free cyber liability insurance. Now, it's not a fully comprehensive policy. I think it gives you something like 25 grand of cover, but it's worth having nonetheless. For those companies that would be more comprehensive cyber insurance certification, then it's probably worth speaking to a third party. The other thing to note on this is an annual thing that we need to go through each year. So once you've achieved your certification, that's a great win. Renewing each year, you'll still pay that assessment fee again to renew your answers. Now, the other thing to note is that the question sets change from year to year. They get tighter and tighter. So, for example, a couple of years ago, when you had bring your own devices, where staff could bring their own personal devices, they could be considered out of scope of the assessment. Nowadays, it's a lot more stringent, a lot tighter controls. So all devices are in scope, even if it's like personally owned devices. If they are accessing company data, whether that's email, whether that's data in 365 or on Google platforms, they are now all considered in scope. So the requirements get more and more onerous, and rightly so too, because you need to start shutting down these security holes where you can do. So each year you need to self-certify. Generally, it's a copy and paste operation, so year 2 and subsequent years should be a lot easier. But just do bear in mind that these question sets do change slightly. And then there's a stat at the bottom, just taken from the government website. This number's growing, 7.7 million cyber crimes each year. That's going up a lot. Now, with the likes of Co-op and Marks and Spencer, they've really got decent cyber protection in place. So there's other ways these hackers will try and get around those platforms, like social engineering, sort of going after your staff. So that's outside of the scope of the Cyber Essentials assessment. The idea of this is to make yourself about 80% as secure as you can be just by following some basic principles.